G'day everyone, welcome back to another episode of Spark Your Fire. I'm your host Dave Shee as always, and we've got a lovely friend John Camino on the other side of the computer with me today. How are you doing, John?
Good, David. Yeah, very well, very well. How are you today?
Good,
First
mate.
day of
Very
spring.
good. It's first of spring, yeah. Look, you start of spring, so it's interesting to see where the property prices start springing back. That's what we
Yes.
expect. Winter was an unusual winter this year, from what I'm hearing. The sales listings certainly started trending up in the last couple of weeks. So, it will be an interesting one to see whether there's going to be more stock coming back up to the market and how that will do with the prices in general. But look, we're not talking about our usual catch up today. I think it's about time. We've spoken about it for a few times. We want to see what's the latest gold to Sydney ratio, and also what's the Sydney to capital cities ratio, to actually give our listeners and audiences an idea of what's the latest and where can you find value in today's market. Really, I think that's ultimately what we're trying to help. We're trying to guide our investors on. We are always seeking value, as we know, as investors. So it's naturally to be guided by where we think there is value. And, we've done this a few times. John's obviously had his very, very excellent methodical approach in terms of working out. And more importantly, it's look at trends as well. So a bit of a trend analysis and see where things are heading in potentially in the next 6 to 12 months to give people a bit of a foresight. Okay, so. All right, so I think we called this series, I don't know, is Australian real estate too expensive? It's being a part X now. I don't know, I've lost track.
Yep.
I've done it a few times, but anyway, it's the continuation on. And if I can recall correctly, last time, it's about February or March that we did it as well. So it's been about a good 6 months. So timing for us to bring it back, John. And I certainly know that you put in a lot of effort in putting these. So thank you in advance in taking us and taking all our listeners across the latest data sets.
No worries. And just to add a footnote before we get started, like this is fairly unique stuff, except for the other times we've done this. but what I'm saying is that these measuring the price of real estate in gold and then measuring each capital city, the ratio to each other, is really the only valuation system that works, because every other methodology, we're being befuddled by fiat currencies and inflation. This is the only methodology that looks through that, and it's always right. So let's get into it, and we'll pick up some previous sort of predictions at previous points in the charts, and we'll talk about whether those were correct, because it's a very reliable methodology. Shall I get into it?
Looking forward to it, mate. Let's kick
All
off.
right. So just a bit of so we'll start quickly before we get into those snazzy ratios. We'll just quickly touch on where Sydney is. Sydney, for this exercise, tends to be a bit of an anchor market, so it's a little bit unfair, but it's just to go through what we've seen over the last. Well, this is a 20-year chart, so this goes through the change in Sydney house prices. So when the prices are hot as they were in 2021, that's one of these peaks over here on the right, and the trough in 2022 over here. Now, the trough we saw in 2022 was the biggest trough we'd seen in 20 years. And what that means is it was the sharpest and deepest fall in house prices. And prior to that, it was 2018. So we've seen two massive corrections within 5 years, the two biggest corrections within 5 years. And the reason I kind of point out these two troughs here that they've happened so recently is, and of course, the 2021 peak was the biggest peak ever. But there's a couple of things to notice here. One is there's been quite a bit of volatility in the last decade, particularly in the last 5 years. That's unusual for real estate. It's not healthy for real estate. It shakes some people out. But also, I think it also partly helps explain why this correction, which no one can understand, the correction that's happening at the moment, interest rates are going up and yet prices are still going up. And part of that is because, the gold to real estate ratios will show this as well, but we had some major corrections. The real estate really hasn't done that much since about 2017. besides a big blow off top in 2021, it's been interjected by two big corrections. So that's worth noting, that what we're seeing now again is this sort of correction to the mean. The other thing that I like about this chart is that it shows real estate prices they go through cycles. I mean, it goes up and it goes down, it goes up and goes down. Super reliable, and kind of like the waves of a boat, or the waves of the ocean. I mean, it's going to go up and down, and you can't panic when it goes down, and you can't get too elated when it goes up, because the growth rate's just like a piano accordion. It just goes in and out and in and out like the waves of the sea. So yes, never get too excited when the peaks are here, nor too depressed when the troughs are here. Any thoughts on that one before we move on?
It's part of natural cycle, basically.
Yeah, exactly. That's right.
Yeah, as you said, I think it worked out that yeah, we are the trend now seems like we are moving back into the positive territory. So yeah, it's interesting to see. Certainly, especially with Sydney as well. I think coming back to the magnitude of these changes, it's somewhat related to all the fiat currency that's been released in the last since COVID period, right? When the globe is crazily printing money, we're talking about trillions and trillions of liquidity that's been injected into the financial system. Needless to say, the magnitude is going to change, and it's going to be bigger swings, whether it's positive or negative, either way. So
yeah.
I guess brace ourselves. I think if this one's going to go up, it's going to be even bigger than Ben-Hur. But if it goes down, it's going to be sliding faster than ever too. So
yeah, it's a bit like whack-a-mole. So the central bank can print a bunch of money. They can stabilize and put a lid on the banking system, so they can stabilize that one. But the volatility has to pop up somewhere else, and that volatility always pops up in prices. So prices do that, but we've stabilized the banking system, and which is usually the aim of the currency creation.
Yep.
Last point on this one is that for real estate investors, that the line is above zero most of the time. So it spends most of its time on the top part of the page, which means real estate is growing most of the time, and it's only rarely, or it's less often that it's below the line, which means that it's contracting less frequently than it's expanding, but it does contract. So this is a very flat chart of house prices since 1979. We show this every time. Normally, I sort of chart the recessions on there, and you've got the peaks and the troughs, some big moments in 1987, and then the big run up to 2004, 2003, 2004. Pardon me. The 2003, 2004 boom was the biggest we've ever had. And then we sort of move into this post-2008 world where you get the volatility, right? And so one of the things, so you see this sort of smooth capital appreciation over time from the 70s onwards.
Yep.
And then 2008, and it's like, boom, it's all on. And we get these big booms and these big crashes. And we're just, that's what we're still seeing at the moment. One of the ways I've described this in the past is a rolling series of V-shaped recoveries. So you can see that that's exactly what we're in at the moment. These big crashes. I suspect that if they stabilize interest rates at a higher level and they leave them there, that probably will bring an end to that level of sort of asset volatility. But certainly that's been the prevailing market for 2008, or you could say that's been the prevailing winds since for this century. This century, I would say that monetary policy has been absolutely terrible, and that's why we're seeing the volatility in the housing markets.
Yeah, no, absolutely. But I think it's good to see that certainly it's started to recover again. I think that's what most investors are, especially invested in Sydney as well, right? We are seeing that V shape started to forming again. Although I'm not sure whether it's going to be a W or V in this case, but I think either way, at the moment, the trend seems to be on its way up, heading back towards the COVID levels where we hit 1.4. Now it's kind of moving and accelerating towards that. So it's a positive side, but Yeah, I think I wonder whether from 2008, and that corresponds to about the GFC times, and that's the first time when they start printing money. That's where the system started to get a bit more jittery from that point onwards. And then, as you said, it's a rolling V shape every time.
Yeah.
Seems to be.
I'd say probably actually. I said 2008. It's probably been since September 11 actually that this has really become a little bit more unstable. And I suspect a chart of the Dow Jones would show us the same thing. But So we're nearly back at the peaks. I feel uncomfortable anytime a market moves too quickly in either direction, which is what this is showing. But nonetheless, that's nominal. So this is nominal house prices, and it's again, like real estate is definitely worth owning because it's going to do this over time. And even if you can put up with the last 10 years or 20 years of volatility, it's still really positive. So house prices do have a good track record. Now, if we move over to what we call real house prices, so real house prices are house prices priced in money rather than in fiat currency. So when we price real estate, or if you price anything in gold or money, you can see that rather than just this one asset or this one price just going up forever and eventually buying the world, what's actually happening is it's just going up and down, up and down, up and down, like prices normally do, and nothing goes up forever because it's trapped in like a valuation channel. The great thing about gold is it's a proxy for, as I said, real money, but this irons out essentially currency debasement because you can't print gold. So the difference between this chart and that chart, and if I was to shade the area between, the difference between the two lines is the value that the Australian dollar has lost. And the number, they really started to diverge in about 2004, where this line kept going higher and this line came down. And so 2004 onwards has been a period of quite substantial AUD depreciation. And that's what's really happening here. But Australian dollar depreciation, it doesn't necessarily show up in nominal asset prices. And that's why it's really valuable to see what's actually happening to our wealth here. So what we've said is that in real terms, real estate's bouncing it's stuck in this valuation channel between about 400 ounces to buy a house. And when it's there, it's cheap, and about 600 ounces. So it's always between those two levels. Now, the last time we showed this a couple of months ago, we were in February, and we said, the market is bottoming very soon. And the actual bottom, we would have been at around this point. And I wasn't sure whether it would get all the way to 400. I think I said it would get to 400. It got very close, but it bottomed out at 416 ounces in May. So we were 2 months early when we said that. And it's really reliable. Like, this is exactly what's happening. And the market's not going to go down from here. So what this chart tells us, if it's just bounces between 400 and 600 ounces, is that the real estate market is going to go up until it reaches overvaluation at about 600 ounces. That could take years. Pardon me, that could take years. But the point is that the trajectory is up and it's not down. So I suspect real estate will keep going up until perhaps this ties into the Perhaps this ties into the 18-year forecast, and maybe it hits the 600-ounce mark in 2026. Over to you, David.
Yeah, I mean, every time when I look at this chart, it's fascinating, I have to say. To say because it's it always seems to be bouncing in between the 400 and 600, except obviously before 1988, where that was below 200, and then from about 2003, 2004, we're absolutely peaked at over 1,000 ounces, which is just absolutely gobsmacking when I think about that. But after that, things started coming back into more of a normality, and we're between the 400 and the 600s, and history tends to repeat itself to that extent. And I wonder whether the 18-year rule is gonna happen again. It is, as I said in our last podcast, it is very difficult to fathom to a degree, but
this would back it up. So I had to throw it over to you, David, so I could cough. Confession there. So thank you for for covering there. Uh, so I think that the message here is actually that real estate's not not expensive, even though it feels it. I mean, this is what we're trying to analyze here as analysts, whether real estate is really expensive or if it just feels expensive or if everything's expensive. And I think the message here is that if something moves up during an inflation, it's not really moving up. It's just maintaining parity. So it's just keeping up, but it's not outperforming. So real estate over the last couple of years, I mean, see, this is not rents. Remember, rents have outperformed inflation, but this is just property prices. So when everything in an inflation where currency's been created, everything moves up in price. Then if real estate is just moving up at CPI, in real terms, it's going sideways. So I think we can say that while real estate's had a bit of a pop, a little bit of a bump, over the last, period of time, it's really just been swept up in a general inflation across all the major economies, and real estate isn't doing anything special. So yes, I think it's got a few more years to run. I think it needs to get up to 600 ounces. If it blows past it, I'd be surprised actually, but it's possible. It could do what it did in 2004. But I don't think that will happen. I think we reassess when it gets to 2000 to 600 ounces, and we see if we're in a sort of unstoppable bubble. But that's where you kind of have to worry a little bit. So there's no need to worry at 460 ounces to buy a property. We've got some runway. It's going up.
Back in February when we did sorry, John. Back in February when we did the last one, I think the goal was at 435 ounces, and now today it's at 460. So all in all, we're not too far from each other. In other words, it's still relatively good time to be getting into the Sydney market. But if you want to put into a context, I guess the bottom happened to be around May 2023. So if someone is trying to time the market, that would have been the bottom or the most closest bottom that people would have get in. Is that correct?
That's right. And before that, it was November 2020. But it keeps, and before that, it was, I think, 2008 or so. Yeah,
that's right. Okay. I just before just for me to put a bit of a dummies question out there.
No, definitely.
How people will read it correctly.
It's good for context that we are certainly nowhere near bubble territory at the moment. It's just keeping up. Oh, pardon me. All right, both got coughs, I think. Comparing the capitals. So the way we did this last time was we went through the overvalued capitals first.
Correct.
And then we went through the undervalued capitals. Now we've kept them in the same order, but I don't know if they're necessarily all overvalued. So let's revisit what were the overvalued and undervalued capitals, because there's been a lot of between the capitals. There's actually been a little bit of movement with Sydney outperforming what were previously the overvalued capitals. Don't seem to be so overvalued anymore. Let's have a look. The big one, obviously Brisbane's the market that gets a lot of attention for good reason. It's very investor friendly. You get good yields and it feels cheap. But actually, the last time we met up, it was quite overvalued. It was around here. This bottom here was where Brisbane was at the time compared to Sydney. Now, Sydney again, we're looking at ratios, so we know that it always bounces between, let's say, 150 to 200 ounces. Sometimes it blows over when Sydney's really expensive, or sometimes it goes under 150% when Brisbane's really expensive. But right now we're in the sweet spot. You could definitely, I don't think I could claim that Brisbane is overvalued right now. I think Brisbane's in a good spot. Brisbane was doing really, really well. I think it kind of needed a year to consolidate. Because it looks like it's off for another good run, and it probably will perform well all the way up to the Olympics. But right now, Brisbane is not an overvalued capital the way it was, let's say, 9 months ago.
Seems to be a balanced market. Look at kind of between the midpoint, between about the 125 to about 225 ish to that extent. Can you just remind us what's the dotted line again across the
right? So the dotted line is actually the line of best fit. So it's not the average Sydney to Brisbane ratio over the last, what's that, 50 years.
Mm.
It's just a line of fit. And what it says is since 1979, Sydney has marginally overperformed Brisbane. So if you were an investor in the 1970s, you would want to have purchased in Sydney. In this example, well, in this data set. So, and this will change over time, but so far it's been in Sydney's favour.
Okay, interesting. It is slightly higher, but it's not drastically higher.
Yeah.
So
I think Brisbane's a great investor city. I think it kind of needs to internationalize and maybe like attract hedge fund managers and those sorts of things. But I think it's certainly experienced a population boom at the moment. And I don't have any particular insight there, but it seems like it's fairly safe money at the moment. You know Brisbane much better than I do, David. So if I go to the next one. So this is the Sydney to Canberra ratio. Again, Canberra was quite overvalued when we last met. It was nearly this 120% ratio, which is when Canberra's overvalued. But actually, it's really very quickly corrected because Canberra hasn't done very well and Sydney's done really well over the last year. And so I think Canberra is still actually a tiny bit overvalued. I think I'd like to see it closer to 150%. The Sydney to Brisbane ratio before I would claim that it's neutral in the way that Brisbane is neutral now. Canberra is still more expensive than Sydney by historical values. And as you can see, over the last, so this goes back to 1990, over the last 40 years, you would have wanted to invest in Canberra over Sydney. So it still looks like Canberra's got a little bit of steam to blow off. It seems to be happening quite quickly, though. So Canberra's still a little bit overvalued.
Good summary.
Adelaide's a lot of chatter about Adelaide. Pardon me. It doesn't look as outrageous when I look at this chart. It looks like Adelaide is overvalued to neutral. It's a little bit overvalued. I think Sydney's going to continue to outperform Adelaide for maybe another year, but it's not outrageous. And this is the thing about Adelaide is it's been doing catch up. It hasn't been like reaching forward and getting overvalued. A little bit, but it's been generally speaking. It's been generally speaking playing catch up after this period here of where Sydney was relatively overvalued. So, yeah, and you can also see this line of best fit is actually quite flat compared to all the other ratios. So, you could make a case that Adelaide correlates quite closely to Sydney, actually. And, we talk about Sydney being a great performing capital. I mean, since 1993, Adelaide has performed just as well. Actually, it's quite a flat line. So maybe if you want Sydney style returns at a fraction of the price, maybe Adelaide is the best long term bet. I hadn't thought of that.
Without all the headaches and without all that fluctuations and in the peaks and ups and downs, by the sounds of it, seems to be we all know that Adelaide is a slow and steady market and has been that way for a long time. So, but when you compare between this snapshot between 93 to 2023, which is technically speaking 30 years, and you can get the same return, essentially the same return if you invest something in Adelaide as opposed to investing in Sydney today. From a dollar value perspective, it's probably going to be quite different. But you're talking about a percentage
gap,
so
returns.
So if it's percentage side of things, then that's it's fascinating.
Yeah, and I wear Sydney underpants over here, but you're probably getting a better yield in Adelaide too. So and it doesn't capture that here. So that's interesting.
Funny that peak was the previous peak that where Sydney was overvalued was in 2021, I think that was, and then since then Adelaide's been catching up. So I think that corresponds to the COVID period.
Yes, right.
Where kind of people try to get away from the big cities and then try to move back into the region because that's around the time when the work from home is most common, right? And then now the employers are starting to ask the employees to come back into the office, so people are forced to come back more into the Sydney spaces as such and start ditching the regional areas as well as the smaller capital cities, let's say. So maybe
Yeah.
there's a correlation there too. I don't know.
That's a good point, actually, because when COVID happened, the internationals all fled, and they weren't fleeing Adelaide; they were fleeing Melbourne and Sydney. So, and that's what that line down was. Yeah. So, Adelaide's very stable, isn't it? Very stable. Yeah, quite. All right, some smart money going there as well. Sydney to Hobart ratio. Look at that. Look at that.
Oh.
So this is the, I think we said it was the most overvalued capital when we last we last spoke, right?
Yeah.
We did too. And again, this is an example of the money since 1996. So Hobart has outperformed Sydney most of the time since the 90s. And there's been a bit of a correction here, but according to the ratio, Hobart is still quite overvalued, anything under 200%, actually. So it's still quite overvalued. I'd probably say, and we might draw our conclusions towards the end, but Hobart's still probably the most overvalued city. And actually, when we look at the August data, which just came out today, it's the only capital that went down, isn't it?
Oh, it's slightly negative, but we're talking about like literally 0%. So it's holding flat.
Right. And this is the beauty of this. So these ratios can predict that short-term performance. But any thoughts on Hobart or in this chart?
It's certainly correcting a lot quicker. I think last time when we looked at it, it was kind of going horizontally at around the 160%, 175, 170% mark, and now it's basically going up. You can see the trend is literally racing towards 200% and normalizing quickly. So Hobart's losing value. Well, I shouldn't say that, but it's basically correcting fast.
Yeah.
That's what we're seeing at the moment. And that because of the fact that it was the most overvalued during the COVID period, ish. So, should have put my money in that in Hobart back in '96, then, didn't I?
96. That's right. What were you doing in 1996?
If only I know these slides back in 1996. If I can come back to the future.
That's right. Don't bump into your other self. You know the rules. Space-time continuum. Awesome. I mean, geez, that's outperformed. I think that there's also some shortages in terms of just housing in Hobart. So, and that pops up in rent. And I think Propertyology really nailed this about 5-10 years ago. They really nailed that in their analysis. So well done, and a shout out to those guys. Okay, Sydney to Melbourne. So I was really curious to see how Melbourne was performing, because instinctively, and I think we've said it on this podcast, that Melbourne's likely to start turning up as an undervalued capital, possibly the most undervalued.
Yeah.
Excuse me while I cough. It hasn't really. So there's been a big correction, but it's still obvious from this chart that Melbourne was blowing off quite a lot of overvaluation. And it feels quite neutral. This reminds me of the Brisbane chart. So I was expecting to see Melbourne as quite cheap, and it looks like it's sort of in the middle of the neutral range. But here's the catch, though. If you look at the direction of the line, Melbourne is getting cheaper rapidly. It's just not keeping up with the other capitals and not keeping up with Sydney in particular. So Melbourne is probably the market to be looking at over the next 2 years, if that trend continues. But any thoughts from your good self on that one, David?
Last time we thought it's going to move more towards the middle line, more towards those 120%, but instead it's gone back up again. So it keeps on losing value. So as you said, I actually do agree with you. I think Melbourne in the next couple of years presents some excellent opportunities, and this kind of reflects to our conversation when we talk about the CoreLogic monthly data as well. I was always amazed at how close the median prices Brisbane and Melbourne are for the recent months. In fact, the most recent month in August, we're talking about only about $20,000 difference in terms of the median value. I don't think I've ever seen these two cities so close in terms of that median value ever. I think Melbourne traditionally has always been about 100K over Brisbane in that extent. So that kind of shows that Melbourne has got a lot of value. to invest in. But having said that, we also touched on there's quite a bit of headwinds in terms of the state government restrictions that have been put onto property investors, disincentivizing people or property investors putting money in Melbourne. So that could have an impact in the long run. Whether Melbourne will be able to go back to its glory days is questionable. Might not be in the short term, because as we know, a lot of times property investors do make decisions based on yield, but yield is terrible at the moment in Melbourne as well. And also, with Dan Andrews' government imposing more restrictions on it, there's a lot of headwinds that's kind of getting Melbourne back to where it was or where it's meant to be. But having said that, look, things can change pretty quickly, because we all know Melbourne is an immigration city, or in fact, probably the #1 immigration city as migrants come in. So that presents a lot of job opportunities, and that presents a lot of potential for recovery. And if it does recover, it's probably going to recover quite quickly.
Yes, definitely looking compelling. And again, if we're concerned about political risks in Melbourne, I mean, they're all just passing through institutions, so those things are temporary. So I've got a question to ask you after the next slide. So I think everyone's been wanting to see where Perth lines up. Perth is another interesting. So it's Brisbane and Perth, the interesting ones. Throw Melbourne in there as well. Perth, it was heavily undervalued compared to Sydney, and that's definitely been correcting. It's sort of coming down to, towards the trend, but Perth is still undervalued. Perth is still undervalued according to this. So, but it's been doing a bit of a stealth correction. I feel like I find that Perth hasn't been knocking anyone's socks off, but actually it's been outperforming Sydney for the last year or two. And but it's still definitely, I mean, anything over 140%, it's cheap. It's cheap compared to Sydney. So you invest in Perth to some degree at a risk because there's volatility of commodity cycles and so on. But I think that, if done well, it can be very profitable. I don't know anything about the market itself, but I know about a little bit about the commodity markets. I know a little bit about the ratios, but I don't know anything particularly about Perth in itself. But certainly still in our undervalued category. And I think, last time it was the most undervalued. Maybe I think it still is.
It was, yeah. But I think it's still very strong at the moment in comparison to
Thoughts on Perth, David? I'm gonna throw a question to you after your initial response, but
Did you change the scale? So, because I was comparing to what we had last time. Did you happen to change the scale on the bottom in terms of the time scale? Not really. Maybe we're just zooming. Okay, because the graphs look slightly different, but anyway, that's okay. I think that corresponds to why a lot of investors are still eyeing on Perth at the moment, because they can still see value. It's probably only one of the very few capital cities in Australia where you can still achieve a relatively neutral type of yield, when majority of the other ones are all pretty much negative in the current interest rate. So needless to say, when people want to invest in, they don't want to forking out money, then Perth is currently the capital city to go. And so I think all that trajectory, all that trend kind of moving more towards Perth being overvalued is investor driven, pretty much. But look at what the mining boom can do back around the 2006 and 2008 period, right? Like it went all the way down to 80%, which, wow, it's just amazing. Is it going to do the same? Who knows? But I think, certainly for it to continue to come back, because it has been undervalued for so long since then. It's a natural trajectory, a bit like Adelaide, to be bouncing back after all that period. So good to see the trajectory there. But I reckon in maybe 6 to 12 months' time, the narrative might be quite different. I reckon at that point in time, Melbourne will probably be leading that correction, or in terms of being valued or undervalued capital, whereas Perth's going to be swinging maybe in the second, third in that space. Yeah.
Oh, so excellent. Great minds think alike, David. So you preempted my question. My question was, so if I gave you $800,000 right now, today, and you had to buy in September, so you had to buy this month,
Mm.
as in you had to buy now, where would you buy? Would you buy in Perth or would you buy in Melbourne? I want to ignore the other capitals for now. Perth or Melbourne?
Bit difficult. I don't think you can get much things in Melbourne for that price, to be honest.
Right. Let's say $1 million then.
Million. Okay. I would probably still put my eyes on Perth at the moment.
Right.
Yeah. What about you?
Yeah.
What do you think?
With the caveat that I know very little about both markets, based on these charts, I would agree with you. I'd say Perth as well. I think in many ways, Melbourne's probably the bigger opportunity, but just not yet. And so my reason is that, quite simply looking at these charts, in Perth, the momentum is with Perth. So it's coming down and it's correcting in the right way for a Perth investor right now.
Correct.
In Melbourne, it's still going towards Sydney. So it's underperforming Sydney. And there's no suggestion from the charts that it's turning around. So I still think that Melbourne's going to get a bit cheaper. It's going to underperform Sydney for maybe another year, but it's just sowing the seeds for some good investing. So if I had to do it right now, it would be Perth as well.
Although for argument's sake, John, I guess, isn't it good to be able to buy when it's kind of moving more towards Sydney overvalued than Sydney undervalued in that sense? So in that case, because Melbourne is still trending towards Sydney overvalued in that case, in other words, it's proving to be more affordable or have more value over Perth. And Perth could be more neutral in 3 to 6 months' time. Is it?
Yeah.
So from a timing perspective, it should be the other way around. You should be putting money into the Melbourne.
Yeah. True. I just think right now Perth is more undervalued, and correcting, whereas Melbourne is less undervalued and underperforming. So if those combos made sense. All right, we're going to need to wrap it soon. So let's go to our last capital, Darwin. Oh, I'm just wondering if Darwin's more undervalued than Perth. So this is an interesting one. Like this, Darwin never quite obeys the thesis. It looks really undervalued, and sometimes it overperforms, and sometimes it underperforms, and so it doesn't quite obey John's model here. So naughty Darwin, but generally speaking, it is very undervalued, and it's been underperforming Sydney since the 90s, although it's a fairly flat line, not to the same degree as, say, Adelaide, but yes. So Darwin is another area of undervaluation compared to Sydney. David, anything on Darwin?
I don't know anything about that city, unfortunately, but looking just purely from the chart, it might be on one of the top 3 undervalued cities very, very soon, if not already, I guess. Yeah. So
one thing I'd add, and this is probably a totally irrelevant chart pattern that may not even apply here, but it looks like a cup and handle formation, where you have the cup and then the handle of the coffee mug. And what that normally means is that the chart is going to go up next, which means that it's going to Sydney will outperform. I don't know if that's true, and I don't know if I'm reading the chart right, but it looks a bit cup and handlish.
We might need to look at Darwin more closely in the next. Maybe
you do.
I think they might present some opportunities. You never know.
Yeah.
Potentially after Perth and before Melbourne starts to run as well. So.
All right. I mean, I think in my just to maybe put a conclusion down there. So the first conclusion, if I go back to the gold to Sydney ratio, is that the markets are just enjoying a general inflation. I say enjoying because it's an asset and the prices are going up. So I don't think there's anything particularly outrageous happening in the real estate market in terms of bubble territory. So I don't think we're anywhere near a bubble. I think and this is going to sound crazy, but snip this bit. I think we're still on the cheap side. I think Sydney is still on the cheap side, which I know sounds insane, but I think it's part of this idea that there's a general inflation and the Aussie dollar is getting slammed. So I think a lot of the money is foreign money, and when you measure it in something more neutral like gold or US dollars, Sydney property is looking quite cheap at the moment. Second thing is something I didn't know before, but I think that the non-mining capitals are fairly correlated. So Adelaide and Sydney seem to be correlated, and I'd throw Melbourne in there as well.
Yeah.
And then you've got sort of the other capitals that have a bit of a mining bent, like Queensland and Perth and so on. They seem to have a correlation as well. So I personally think that the next couple of years are going to be very, very positive for real estate. I certainly think the line is going up. And then the question then becomes, well, which capital do you invest in? And it's probably a coin toss between Melbourne and Perth, and you can chuck Darwin in there for our gamblers out there. But but they seem to be the undervalued capitals right now. And I'd also say that Brisbane looks like it's just got its breath back and is looking for another run higher.
Yes, indeed.
Any final thoughts from you, David?
No, I think that's a great summary. I think it also, it gives our listeners a bit of perspectives in terms of where we are today and where we're heading. As a matter of fact, I think the three most undervalued capitals still remained to be the same as last time. So that we had Melbourne, Perth, and Darwin happens to be the case. Whether that's going to be this case the same in 6 months' time, we don't know. Things could change quite rapidly. Maybe Brisbane's going to be in the game as well, being joining into competing into the top threes in the most affordable capital cities. But yeah, look, I think it's just this concept about money value, because we are living in an inflationary environment. So yes, it is difficult to fathom. And when you look at a house in Sydney that could be between $2 to $3 million, you think that's just crazy expensive. But when you compare it to this extent, and great thing that you mentioned international money, because yes, that's another metrics in terms of how foreign investors look at comparing Sydney property against potentially their own market, etc., using maybe the gold as a standard, like what we've done here. It's not expensive, basically. So I think that gives a bit of idea about different perspectives in that sense. But yeah, I think great summary overall. Thank you, John, in terms of putting all that time and effort into covering this as always. And I think we'll have a very, very interesting 6 months ahead of us, because I think interest rate is starting to stabilize, as we all know, like it's moving into that territory. I know investor confidence is starting to come back because of that fact as well. It all comes down now to what lending is going to do in the next 6 to 12 months. If they start to relax lending, even though interest rate may remain the same for a bit longer, the investors will definitely be a lot more interested in terms of coming back into the market. So,
very exciting time. Yeah, it's actually quite a good time to be in real estate, and all of these charts always ignore rents, but rents are a really important part of the investing equation. So it's important to consider those things as well. And we talked about yield during the conversation, but that's definitely part of it as well.
Indeed. Yeah. Okay. Awesome. All right. Well, thanks, John. And look, thank you, listeners and viewers. Thank you for joining us for another episode of Spark Your Fire. Hope you guys have a wonderful week, and we'll see you guys again in next episode. Cheers, John and David.